Hello, this is Brandon Christy, President of Retirement Benefits Institute. I'm glad to bring to you today a conversation on the Roth Ira and Roth Tsp. Well, the Roth Tsp is a viable option for the federal employees to consider. First, let's look at the basics of the Roth Tsp. In the Roth, for tax purposes, consider these accounts as wrappers for your money. Money goes into this wrapper after tax, thus you've already paid tax on the seed of your investment. Inside of the Roth Tsp, you can have the G, F, C, S, and I, or even the L funds. Or if you have a Roth IRA, you can have mutual funds, annuities, gold, real estate, many other options. The money in these Roth accounts grows tax-free. The distribution from these accounts can be tax-free. The overarching principle: pay tax on the seed, not on the harvest. First, we should examine the key benefits of a Roth IRA, then the Roth Tsp. Most importantly, there are no taxes or penalties on the gains when minimum requirements are met. Generally, you must hold the Roth IRA for 5 years and be over 59 and a half. You have full access to your basis in a Roth IRA immediately. To illustrate, if you place $5,000 in a Roth IRA, the next day you can withdraw your $5,000 with no tax or penalty consequences. There's also no required minimum distributions on a Roth IRA. There are required minimum distributions on TSP funds. We'll look more at that in just a moment. Note, if your adjusted gross income is over certain limits every year, you cannot contribute money directly to a Roth IRA. Contribution limits exist with catch-up opportunities as well, if you are 50 or older. Separately, you may convert an existing IRA to a Roth IRA at any time. You'll pay taxes on such conversion, so be careful when you're doing this. You cannot convert existing TSP money to Roth Tsp. All right, as a side note for you CSRS that are left, you have an opportunity to create a large Roth IRA based on certain criteria used within the voluntary contribution program. CSRS are the only ones that can participate in this program. You can contribute up to 10% of your lifetime earnings as a CSRS into the voluntary contribution program and then roll that money into a Roth IRA. Please review our other videos and material on the subject for more detail. Now, for the details on the Roth Tsp, you have the same limits that you had with your traditional TSP contributions. These limits should continue to increase based on inflationary effects. These limits are ERISA rules limits and are not your individual account limits, giving much more flexibility and opportunity to contribute. By the way, you may be able to contribute to a Roth IRA and the Roth Tsp in the same year. Contributions to these programs are completely separate and distinct from each other. A few things to watch to know what the TSP is not. There's no income restrictions. You cannot convert existing traditional TSP to a Roth Tsp, although the Small Business Jobs Act of 2020 permits such an option if the plan sponsor elects to allow it. The TSP at this point does not permit it. Next, TSP is not all or nothing. You can contribute any portion of your funds to the traditional TSP or the Roth Tsp. And lastly, for FERS, the employer match will not be contributed to the Roth Tsp. They love you, but not that much. Their contribution will go into the traditional bucket. Let's look at an example of what this means to our net paycheck. Assume you have an $80,000 annual wage, you have your gross pay, and a TSP contribution of $600 per pay period after estimated tax. And again, we're estimating just to give you a ballpark of how this would affect you personally. Your net pay would be around that $1,700 mark per pay period. If you would change that $600 of traditional TSP contributions to a Roth contribution, you would incur more taxes on your current pay stub and take a net reduction in your pay at approximately $125 per pay period. If you're not comfortable with the reduction in your pay, consider reducing your contribution amount to the TSP as a whole. always make sure you are contributing to at least your 5% to get that match as a FERS employee. Next, let's look at one reason why someone would consider a Roth TSP. So we have here the tax bracket system in America today. We find that when a couple makes more than a certain amount of taxable income, the marginal rate moves from 12% to 22%. Let's assume that your taxable income was $10,000 above the top of the 12% bracket. You should consider contributing about the $10,000 to the traditional TSP. Once your total taxable income drop below the 22% bracket, you may want to contribute the remaining dollars to the Roth TSP component, allowing your current income to stay at the top of the 12% bracket. Spending the dollars on taxes on the Roth TSP at the 12 cents on the dollar rate, but saving the tax dollars on the traditional TSP at the 22% on the dollar rate. Do be careful to think through how such decisions and strategies will affect your tax return. Be mindful of alternative minimum tax, medical costs, Medicare surcharge, and other phase-outs. For additional information, you can call us at Retirement Benefits Institute. We will be glad to walk through the pros and cons of your long-term planning, because your number one question for over 10 years now, we've heard it every day, day in, day out. Will I have enough money in retirement? And one of the key answers to having enough is managing the tax implications of your retirement account. Call our analyst now. You can click the Get Support button. We'll be glad to help you.